Welcome to the Free from Wall Street podcast, where we share how we have done over $200 million in real estate deals to create, preserve, and pass on generational wealth without the roller coaster ride of the stock market. If you're ready to start investing with purpose, visit freefromwallstreet.com. But for now, let's dive into this episode. Welcome back to the Free from Wall Street podcast. My name is Steve Libman. I am your host. Thanks for tuning in once again to get your fix of real estate investment knowledge. Today, I'm going to be talking to you a little bit about why we are buying slowly right now. So we have the fund that we've created for accredited investors, and we have a lot of capital commitments currently, and a lot of our investors are asking, hey, why can't you take my money yet? Which is a great question, right? Well, there's a couple of reasons, and I just want to dive into them for a couple minutes today, because we have to be cautious, right? We have to be cautiously optimistic when we are purchasing and finding and acquiring real estate. You know, our biggest concern is preservation of capital, right? You've heard us talk about this. We beat this drum constantly. Preservation of capital is number one. Return of capital is number two. How am I getting my money back? And then return on investment is number three. And if we take care of numbers 1 and 2, number 3 should continue to take care of itself. But in this environment, why aren't we pulling triggers? So similar to the residential housing market, commercial housing is also very expensive right now, and numbers are inflated to a place where I think that operators who are purchasing some of these properties at negative cap rates or inverse negative cash flows, you know, it's just not a good investment strategy, right? So we're being super cautious, which means we're going to deploy capital a little bit slower than we typically do, because it has to be the right deal. What does that mean? So, you know, you have inflation, right? Which means the cost of goods are going up. Consumer price index is tied to inflation, which means how much you pay for stuff increases or decreases. So that there's a very tangible effect to that, right? I mean, you know, I think that the last report I saw was inflation was at 8 or 9%. But if you've gone to the gas pumps recently, you know that you're paying probably 30% more or 25% more than you were just a couple of months ago. So is that inflation number real? And that's, you know, always an assessment that we have to do as fund managers, right? As fiduciaries for other people's money. We help manage other people's money and grow their investments. But we have to look at the risk factors as well. So inflation is certainly a risk factor. So as cost of goods go up, what does that mean? How does that affect apartment prices? Well, if your cost of lumber goes up, right, or cost of sheetrock goes up, or the cost of paint goes up, which it is, then when you turn a unit or when a tenant moves out and you have to put somebody back into that unit, it costs more to renovate that. So you have to increase your budget numbers on how you're underwriting these deals to make sure that the money that you're spending, you're getting back in an increased rent, and it makes sense for the return on investment. It's a big strategy is to make sure that you're underwriting things properly, right? And if you're not, this is how people got hurt in 2007, 2008, on the residential side at least, right? Or land development side, because they were developing single family houses and the market went boom. You know, luckily, commercial doesn't do it like that. If you look in 2007, 2008, you'll see that the mortgage default rate was like 7.5% in 2007-8 for residential mortgages, which means about 7.5% of your neighbors were losing their house, defaulting on mortgages. In the commercial real estate world, at 0.4% commercial real estate, right? So multifamily, specifically apartment buildings, were 0.4% of default rate. So what's that mean? Well, that means you were, you know, almost 70 times more likely to default on your residential house than we were to on an apartment building, which is good news. That's why we like this asset class. It tends to be less volatile and it can sustain itself through recessions. It tends to be recession resistant. A lot of people make good high yield, meaning good returns on investment, by buying a property that's in, you know, rough shape or has low rents, and they have to turn that property. They have to go put CapEx. Now that CapEx, that capital expenditure, is not going as far, right? So what I could get in CapEx for $1 million last year is not what I can get for $1 million this year, which means I have to increase my pricing and again, re-underwrite those deals. Interest rates are also rising, right? They expect 11. The Fed has said that they're expecting to do 11 rate hikes in the next 2 years. Well, if that's even at a quarter of a point each, right, you're going to see interest rates potentially double. So again, another very important thing to do is to underwrite those exit refi rates. So if I'm looking to go into a building and spend $5 million in CapEx, and then I'm going to take a refinance to get my money back out and put it into a 10 or 12 year loan, right? I do a bridge loan essentially, and then I go into a long-term debt scenario, which is what a lot of operators do, and we have as well. Well, now are you underwriting that in 2 years, your interest rate is not going to be 3.5% anymore, but could be 6. If it's 6, can you refinance your money out of that deal, right? Because now your debt structure is very different. So anyway, all this to say that there are mitigating factors in every economy that you have to be prepared for. So we are not just cowboying it and going out and buying every deal that looks like it has potential good numbers on it, because the environment is changing, right? And we have to hedge against that environment in inflation and with interest rates. So I'm going to keep this one pretty short today. It's just why we are buying slower. So, to all of our valued investors, we love you guys. We so appreciate the capital commitments that you are making, but we also respect and care for your capital too much to just go out and buy deals just so we can put money to work, because, again, preservation of capital is our first requirement when we're purchasing deals. So it's not to say we won't get a great pipeline, we won't have a great Q2. It's just to say that we are making sure that we are double and triple checking the numbers, because we want to mitigate as much risk as we possibly can. So that is the short of why we are buying a little bit slower. But it's still, deals are always to be had, so we are constantly underwriting and finding the right operators to partner with that have great deal flow. And we're confident that we will be purchasing $150 to $200 million this year, which we're very excited about. But they have to be the right deal, right? They have to check all of the buy boxes for us, because long-term wealth creation is very much tied to how we're underwriting these projects. So hope that explains to you guys a little bit about where we're at in the market and in the market cycle. If you are an operator listening to this, make sure you're doing your due diligence and make sure you're underwriting appropriately. If you're a passive investor, make sure you're asking those questions of your operators, of the people that you're investing with, to say, hey, how are you mitigating the inflationary season that we're in? How are you mitigating the higher interest rates on a potential exit? That also means, by the way, not just a refinance, right? But if I go to sell it and the buyer in 5 years can't get the same loan terms that I have now, it will decrease the price of what they can pay for that property, right? So, there's a lot of underwriting tactics that need to go into how we're underwriting a deal. So thanks for listening to the Free from Wall Street podcast. We will check you on the next one. See ya.
Thanks for listening to the Free from Wall Street podcast. If you like what you hear, leave us a rating and review and let us know what you think.